In this section, we're going to talk about subject to and wraps. So if you guys go on YouTube or listen to podcasts, you've probably heard of subject to. It's pretty similar to wraps, but if you haven't, what it means is just when you take over a property subject to an existing loan that is left in place. So if you go back to the other section where I was talking about title and how that works, we have title, deed of trust, and a promissory note. So in the case of the seller carry, you transfer title if you're doing a note and trust deed, or you just buy a property on a bank loan. With subject to, you also transfer title, but the first deed of trust remains in place. So when you buy a property, you typically place a new loan and pay off the other loan. But with subject to, you're leaving the seller's debt in place and you're servicing it, meaning making payments on their behalf and taking title, ownership to the property. So as you can see in the little graphic, you have the seller who currently owns a property. You have the first deed of trust, which is the bank loan against the property. The seller transfers title to the buyer, but the bank loan stays in place, meaning the seller is still guaranteeing this loan, even though the buyer is servicing it on their behalf.
So the seller, the payments are still being made in their name, correct?
Correct. So it's still affecting their credit. It's if they had bad credit and you're making more payments, it's helping their credit, but their name is still on the loan. And you have separate agreements and you can use an escrow company where you service it and take care of all that, but it is still in their name.
So I keep needing to ask this, but why would a seller do a deal in this way?
Yeah, there's a few different reasons. So one may be because someone's selling a home and they don't have equity in the home, but they could have a super low interest rate. So a buyer would want that property because they can cash flow potentially or have all the other benefits of real estate and get in with very little money. And it would be a win for a seller because they may have to go pay money to sell their property if they sold it conventionally. Or someone, it might not be worth what they need to sell it for if you buy a home and market prices go down. You may also benefit as a seller because you can arbitrage your debt. So let's say you have a 2% interest rate on your loan. You could go sell it to a buyer and charge them a 3, 4, 5% interest rate and collect the spread. So you can actually make more money doing it this way as well.
I'm assuming based on just price too, someone's willing to pay a little bit more for a house that has a 3% interest rate than if they have to go get a 7% interest rate in the current market.
Correct. And when you're buying on subject to, you don't have to go get a new bank loan, so you don't have all the origination fees. You don't have to have your credit pulled unless the seller requests that you do. And you don't have to submit all this documentation.
True.
So you can make it a good deal for both parties, but there are risks involved. The biggest risk is the due on sale clause. So in all these loan covenants, it says if you transfer title to a property, the bank has the right to call the loan due. This doesn't necessarily mean they will call it due, but they have the right to call it due, meaning they give you a letter and they say, hey, in 90 days, your loan is due in full, and they'll give you a few different ways you can remedy it. We're going to talk about lease options, which is one of the ways as well. But yeah, that's by far the biggest risk with this subject to model.
When you complete this transaction and you transfer title, will the title company let the mortgage company know that title transferred?
They typically won't because you're just using a third-party escrow who just sends payments to the existing company that holds the loan.
So how do these banks find out whether they want to call the loan due or even find out that they could?
Yeah, so a lot of these banks are bigger banks, so they're not really tracking and pulling reports on who owns title, but a smaller community bank may notice. But the biggest thing is they would have to go pull a preliminary title report or look at tax returns and different ownership things. So they would have to dive through the records and actually see who owns the property, which isn't that hard to do, which is why there's some other models you can use that can help avoid this. But they would have to go check tax records and different things to actually see.
So if you're a buyer, if you're making on-time payments, it's pretty unlikely that the bank's going to even do the work necessary to go figure all this out.
Yeah, it would be a lot of work for them, and why would they want to call the loan due if there's payments being made? And now they really have two people who have interest in making payments as well. The seller who's still on the hook, plus the buyer who owns the property and doesn't want to lose it.
True.
This is an example of a fourplex I bought creatively, and then I sold on subject to actually. So I was the seller in this case. So I bought this with a partner. He bought it on his loan. We transferred the property to an LLC because I didn't qualify at that time when purchasing. So we both owned it within this LLC now 50-50, and then we sold this property subject to someone else. So technically the loan could have been called twice. Once when we transferred title to our LLC, and then when we sold the property subject to.
It didn't get called though?
No, I've never had it called, and I've seen people actually have the note called in a few instances, but it is pretty rare. The benefit I got from selling this thing subject to was we sold it for something like $160,000, $170,000 more than what we purchased it for, and we collected something like $50,000 to $70,000 on the front end, and then we carried a note on the back end for the remaining equity and collected interest on that note and had a balloon payment on it. So we got to sell the property for more, hit a price we wanted, and lock that in, and then collect interest payments over time, and we did not need all the money on the front end. The benefit to the buyer was they got to purchase this property that they would typically have to put, $150,000 plus down on, and they got to put something like $50,000 to $70,000 down instead.
Yep.
And they got to take over our 3.25% rate we had on this thing. So now we're going to talk about wraps. So wraps are a little interesting, as in the term wrap covers a few different types of deal structures. So I use, and a lot of people use, the term wrap in place of subject to. It's very similar. Typically the difference is you're leaving debt in place and then wrapping new debt around it, or adding a second deed of trust to that property as well.
So to clarify, if a property owner has $150,000 worth of equity above the debt that they already have in place, but you as a buyer don't want to put $150,000 down, let's say that you want to put $50,000 down, the wrap comes into play is the seller, you're asking the seller to carry $100,000 on a seller carry contract, but leaving the debt in place.
Correct. So I could take title to that property that they have $150,000 of equity in. I could give them $50,000 down, and then we could do a second deed of trust with a promissory note for that last $100,000 that says, hey, we pay you back with these terms.
And that $100,000 is what makes it a wrap.
Yes, you're wrapping it, you're adding additional debt on top of the existing debt. So maybe it would just be a subject to if maybe they just had $50,000 of equity and you cash out, or you cash out all $150,000. Again, they're used interchangeably. It's not exact lingo, but just to give you guys an idea. So the other instance when the term wrap is used is with land sales contracts. So if you watch the other section, we talked about land sales contracts as a form of seller carry when an owner owns a property free and clear. It's just when you purchase as a buyer and title remains in their name. You can do this creatively with a wrap as well. So let's say a seller has a property that with debt on it and they don't want to transfer title to you. You can still buy it creatively, very similar to subject to, using a wrap with a land sales contract. So what you would do in this case is use a land sales contract to purchase the property and record a memorandum against title and leave the debt in place. So the title and debt stay in the seller's name in this case, and you record a memorandum that says, I get to take title once I meet these payment terms and X, Y, and Z happens, or I refinance, or I'm selling, or whatever you agreed upon. So this is another way to wrap the existing debt, take it over, by using a land sales contract. So this is an example of a wrap we helped a client structure on a 14-unit apartment complex. So they purchased this for $2.9 million. Again, it was 14 units, and they brought $300,000 down and paid a 6% interest rate. So this was a wrap because we left the existing debt in place and then recorded a land sales contract against the property for them to take ownership and essence of title. When I say essence of title, it means control the property and then go through their whole business plan from there.
Is that the same as clouding title?
It's different than clouding title. When I say clouding title, I mean a cloud, meaning a mark on the preliminary title report showing a document there. When I say essence of title or essence of ownership, I mean they just have full control of the property.
Got it.
So this deal was interesting because there's actually an existing $2 million loan on the property at a 4% interest rate. So the seller got the benefit of arbitraging that debt and collecting a 2% spread, and then they locked in the price. The benefit to the buyer was they got to get into this property with only $300,000 down and still got a better interest rate than today's bank loans.
Got it. So the seller could have decided to sell, hey, you can take over my 4% interest rate, and I'm going to charge you 6% for the wrapped portion of the debt. But he went and said, no, I want to charge you 6% on the whole thing, and he's collecting 2% that entire time that you're paying on that debt.
Correct. So he's collecting a spread on the full loan amount there. So that's a $2.6 million loan because it's $2.9 million price. Buyer brought $300 down, $2.6 million remaining loan that he's paying 6% on, and then the seller has an existing $2 million loan at 4%. So he's collecting a 2% spread on $2 million of it, and then on the remaining $600,000 of it that was his equity, he's collecting the full 6% on.
That sounds like a win-win.
Yeah, so again, win for the buyer, he got to leverage in better rates. Win for the seller, he got to exit the property, hit the price he wanted, doesn't have to worry about managing it anymore.
And arbitrage the debt.
And he got to collect a spread on that debt. This is another example of a wrap we structured for a client on a single family home. So they purchased this for $480,000. It had an existing 2.75% rate on it. And then we structured it so they only had to bring $40,000 down. And then the seller did a $60,000 carry. So in this case, they had $100,000 of equity and a $380,000 loan balance, getting us to that $480 price. And they did not need all the money on the front end. Mm-hmm. So the benefit to the buyer was this is just an investment property for them. So they got to bring less down than they normally would have to. And they got to take over that 2.75% rate. So in this case, they took over that full 2.75% rate. And then we set up the carry of the $60,000 at something like 6 or 7%. So the seller got to collect interest on that money that they were just going to leave in the bank and not really collect interest on.
Yep.
And then got to hit the price they wanted for the home, so we made it a win-win again.
So the win-win in this case comes from the seller was having a harder time selling the home, and they got to sell it at the price they wanted.
Correct. So the buyer technically overpaid for this property. Other buyers did not want to pay this price for this property, purchasing it conventionally, but because he got to take over that 2.75% rate and come in with that amount down, it was a great deal for him.
Got it.
Thanks for watching that section on subject to and wraps. Hope you learned a lot. If you want to start structuring these deals and want our help, sign up at the link below.